Ladies and gentlemen, please welcome your moderator, managing partner at McKinsey & Company, Gary Pinkus.
I don't know, we got the wrong order, I think.
The opposite.
Oh no, we got the right order. 1, 2, 3.
Given the group we've got here, I'm surprised to be the only one introduced. So I will. I have the pleasure and the privilege of moderating. I think what for many is that one of the critical panels here on the global private equity market. And I've got an incredibly distinguished group of guests who I'll take the liberty of introducing. David Rubenstein, at the end, co-founder and co-CEO for the Carlyle Group. Jonathan Nelson, founder and CEO for Providence Equity Partners. Bruce Flatt, CEO of Brookfield Asset Management, and then John Connaughton, co-managing partner of Bain Capital. And he also reminded me he actually started at my competitor Bain in the early days of Bain Capital. One of the findings of our McKinsey annual report on private markets, which was published a few months back, was that 2016 was actually an exceptional year for private equity. Firms received roughly $625 billion of capital. That was the last time we saw that level of capital flowing into the private equity market was roughly 2007, 2008. You can draw from that whatever you might choose, but that was the last high water mark. And assets under management have grown to roughly $4.7 trillion. So we are seeing an industry that is occupying another golden age, arguably. Now, the number of firms is at an all-time high, and we'll talk a little bit about what that might mean for the industry. The amount of dry powder is also at an all-time high, although that may mean a little less than it once did, given the actual deal volume and velocity. And generally, prices are getting pretty close to an all-time high. So there's a number of dynamics in the industry that I think are going to be fun to explore with our group. What I'm going to do is have a pretty broad-ranging conversation. We'll talk a little bit first about the global context for the industry. We'll do a deeper dive on what's happening in some individual markets, and then we'll close with a discussion around some of the different strategies and different forms the funds have taken. And what we have in, I think, our group today is a really nice mix of different operating strategies, different governance models, different capital structures that I think will come out in the course of our discussion. One other thing I should say by way of introduction is we use the term private equity, but in many ways, the equity we're talking about is not private anymore, and it's not even equity anymore. And so really what we're talking about, broadly speaking, I think is the alternative asset class. And you'll hear us, I think, sometimes in the course of this discussion, mix and match between those two phrases. So I'll begin with a little discussion about global, a little set of questions about global context. Bruce, I might start with you here, given how global your business has been, starting with, I think, Canadian origins. And for those of you who haven't read it, there's been a great article, I think, that just came out quite literally this morning in Forbes on Bruce and his company. They call it one of the least known, most successful companies you don't know much about. And Bruce, maybe let's talk a little bit about populism for a moment. Arguably, it's having a dramatic effect in the United States. It's having a dramatic effect in other parts of the world. As you think about the different places in which you're doing business, do you see this affecting your businesses at all?
Yeah, so thanks for that. And we're in 30 countries. We pick them very specifically. We probably add one a year. We don't have to, and we may not add that many in the future. But where our money's been going, and it probably comes to both points, but where our money's been going in the last 18 months is that we've probably invested of $25 billion that we've put to work in 18 months across all of our businesses. Most of that money has gone to the emerging markets as opposed to developed economies. And that's merely because that's where the opportunities have been. And in those markets, you would have historically found that populism affected things. And certainly, we bought $5 billion of assets, $7 billion of assets in Brazil in the last 12 months. And the movement of populism against the government and all the people that went to jail for the Lava Jato scandals in Brazil was clearly a populist movement with people protesting in the streets. And that you're continuing to see that across the world. And I'd say that affects all businesses. It definitely affects infrastructure. And infrastructure is about outsourcing assets off of government's balance sheets. And people then have to pay for it themselves. And the minute that the people don't trust that government is doing the right thing, populism comes about. And we've seen that in some assets, and that's a dangerous thing to do if you're in the wrong country. So I think you have to be very, very careful about where you go.
Any thoughts from any of our other panelists? An issue in the U.S. or other developed markets?
I think one thing that I think certainly affects, I think, all of our businesses, the fact that, when populism becomes protectionism, and certainly one of the great fears, I think, that results from some of the backlashes that you described is the fact that, governments are using the populism rhetoric to then seek protectionism. Mm-hmm. And certainly, our business is global. We rely on multinational companies being able to perform throughout the world, and I think that the nature of that trade flow, the nature of that competitive advantage for our companies is going to be somewhat limited by that rise in protectionism.
Yeah, it's interesting. We've done some interesting work that looks at protectionism, not just in terms of goods, which is the way we naturally tend to talk about it, but also flows of services and digital services, which arguably the United States is one of the great leaders, where we would be the most disadvantaged. And so I think it is one for us to collectively keep our eye on.
Right.
David, I want to turn to you for a moment. As you think about 2017 and beyond, you've been one of the great multi-asset platforms at Carlyle. What do you get most excited about in the alternative asset place? I know all children are equal, but do you have any personal favorites as you look at your portfolio?
I love every fund we have and every deal we do. I can't say that I favor one over the other. If I do favor one over the other, I'm going to get in trouble with somebody else in the firm. But before I answer that, on the previous question, it would have been thought that because of populism being more important than it had been before, that maybe the rules under which private equity would be governed would change. I don't really see that. I don't think the government of the United States is really going to change the rules. Now, maybe because you've got a capitalist in the White House, you're not going to see the rules change all that much. But a major change which has occurred in the last, I'd say, 5 to 10 years is that private equity used to be beat up by every politician. Nobody liked private equity because we were seen as making a lot of money. We were not doing things that were seen as creating jobs. I think over the last 5 to 10 years, private equity people have learned from some of the mistakes that we've made, and I think we have done a much better job of explaining to people what we actually do in terms of preserving and creating jobs. And as a result of that, I don't think that people around the world are saying, I don't want private equity firms to invest in my country. In fact, they are trying to encourage us to invest in their country. And even in the United States, where from time to time, the Congress, which is not probably the biggest fan of private equity generally, has said that maybe private equity actually does add some value. And I do think that the populist streak against private equity in Congress has probably abated. In terms of your specific question, I think the emerging markets are dangerous in the sense that when you go into emerging markets for long terms, you're probably going to get hit by one of the down cycles. But if you stay for a while in an emerging market, you're probably going to do reasonably well. Right now, 55% of the world's GDP is in the emerging markets, but only 17% of private equity dollars are in the emerging markets. 83% are in the so-called developed markets. So with 17% of private equity dollars going in the emerging markets and 55% of the world's GDP and growing, it's probably the greatest opportunity in the world. And if you take the BRICS, clearly China has been a great leader for private equity, and it will be in the future. India has come on strongly of late, and Brazil, which was mentioned, has had its challenges because of the currency and inflation, but now probably Brazil is really cheap, and compared to where it was a couple years ago, probably a very attractive place to invest. And then the frontier markets, not the more famous kind of emerging markets, I think they offer opportunities as well. So if you know what you're doing and you have a good team on the ground, I think the emerging markets can be among the most attractive places to put money right now.
Jonathan, not at the risk of leading the witness, you and I have had a conversation about emerging markets too. You want to maybe share perhaps a little bit of a counterpoint or an additional point of view?
Sure. Partly to liven this up, I'll disagree with David and test if people are paying attention.
Okay.
But also because I believe in the following counter-argument to the attractiveness of emerging markets. And I've been hearing for more than a decade about the disparity between private equity activity, either measured by commitments or activity, and GDP, and that there's an imbalance, hence it should be attractive, and eventually will level out, and PE or alternatives, the bigger class, should be well correlated with GDP. I don't think that will be the case, and I think it would actually be a mistake. And we're seeing the signs of that now. Most CIOs that I talk to feel underweighted in emerging markets, and there's something attractive at a very high level, which is GDP growth, because US and Europe is somewhere, depending on the country, between -1 and 2.5. And emerging markets are growing at a much faster rate. And that sounds appealing to an investor, except that GDP growth and return on equity, which we should care about as investors, are not well correlated. And in fact, for a dollar-based investor, and most of our investors are actually, there may be in a 5-year period an inverse correlation, because those countries that are growing the fastest tend to have inflation, which for a dollar-based investor, you get whacked somewhere between 1 turn on your money or 1.5, but it's significant. And we've always had deal teams in some part of the world said, no, this was a great deal in local currency, except, and I hear this all the time and it drives me nuts, because our investors only care about, they give us dollars and they want dollars back, and that's how they measure our returns. So I have 2 problems. One is the return. I would say, and there are folks who do a great job in emerging markets, so I'm not discounting that, but I'm talking about as a categorically, it seems to me that returns in emerging markets for over most long periods are the same or lower than developed markets. But the risk is higher, and we're all trained to risk adjust return. So if you can get the same return in the US or in Europe as you get in emerging markets, that sounds to me more compelling, which is actually, and when I have these conversations with CIOs, they always nod, yeah, that's right, the returns aren't better, the risk is higher. And I said, oh, well, are you increasing your allocation? Yes. So and we see this, and it'll be interesting, because we've been on lots of panels. Over time, David is much more often right than wrong. We'll see how this plays out. But so far, as a category, it doesn't stand up risk-adjusted to Europe and the US.
Well,
and that's an unpopular view, I know.
That's true if you're not in a top quartile fund. We're only doing top quartile funds, so we don't have average ones. So we only do top quartile funds, so therefore
so John,
it's different.
I know this, private equity is like Lake Wobegon, where all the children are above average.
I don't mean to gang up on you.
Excuse me?
I don't mean to gang up on you, but I agree with David. And here's the point. And if you're not a good global investor, what you said is true. The fact is, the United States is the greatest place in the world to invest, but it all comes down to value. When multiples are high in the United States, we go elsewhere. When multiples are high in those places, get out, because there's way more risk and you're not getting paid for it. But what happens is, and this is the point I think is really critical to your currency discussion, what happens when a GDP in a country goes down, take India and Brazil, the currency goes down, FDI dries up, there's no money going into the treasuries of those countries, there's no money in the country, nobody can borrow. And the asset values that are given to you, just because there isn't money, are at dramatic discounts with a huge margin of safety. And when that occurs, and you've got the currency working for you, because you had a 50% reduction in currency, so you get currency. So it's all about timing. And I'd agree with your comment. I agree actually with both of you. It's about that, but it's also about when
let me round out the argument. There's one other argument on the table which shows the differentiation in models, I think, to some extent, because the idea behind private equity in emerging markets is a bit of a misnomer in my mind, because a lot of people are playing it just as a macro bet. try to understand just timing. And you can do that well if you're a macro player, but oftentimes the growth markets are overpriced. I would agree that that is one of the biggest challenges, and you do have currency risk. But it's also a really inefficient market. And it's also a market where you can actually transform businesses. You can do what Bain Capital or Carlyle or Providence, and I'm sure you do it in your real estate platform. You can add value to businesses. I mean, private equity at its best is not just a macro play. It's not a time.
Yeah, I'm not talking about a macro play. I'm talking about, like, we have 20,000 people that work for us in Brazil, and we have 10,000 in India.
Play.
And these are operating businesses.
I'm agreeing with that.
All I'm talking about is when you overinvest and underinvest.
Yeah.
And when markets are up, you should pull money out of the country. You should finance things or sell them. And when things are down, you should put money in. And that's all. So
I think that's how you reconcile it. Private equity, top quartile or at its best when it can actually find inefficiencies or add value. Then you can actually be in these markets and actually do quite well in their growth opportunities.
If you look at the statistics, Jonathan is right. Over the last 10 years or even 15 or 20 years, the emerging market average private equity rate of return is roughly the same as the developed market private equity return on average. Obviously, the trick is trying to pick a top quartile fund that will probably outperform this. But one of the things I want people to think about this, the phrase emerging market is a little bit out of date. It was invented in the early 1980s to reflect the fact that there were a lot of countries that were small, Taiwan, Korea, Mexico, that could use some additional American capital into it. And they were talking then about using that phrase to get people to invest in the public markets of those countries. Today, we're still using the phrase emerging markets to talk about the second biggest economy in the world, China or India or Brazil, which are gigantic economies. And ultimately, I think those of us in the West should say these are not emerging markets so much, they have emerged. And they are major players in the global economic scene. And if you're not investing in them, you're going to miss so many opportunities, in my view.
Let me take us back maybe actually to our local market for a moment then, the United States. Arguably, we've got as much uncertainty in both the positive and negative sense as we've had in years, in the sense that we may see our tax laws change fundamentally, we may or may not see a major investment in infrastructure, we may see the healthcare system that we just created recently disappear or disappear in some form. How are you and your teams thinking about investing in the US in light of that type of I'll just call it uncertainty, for lack of a better word?
Well, I'm sorry, go ahead. Somebody want to? I don't think you can make investments for 5 to 10 years worried about legislative actions particularly. Obviously, there are seismic changes from time to time, but I don't think we can wait for the Congress to act before we decide we're going to make a long-term investment. If you think the healthcare area is a good area, in the end, ultimately, whatever Congress does is probably going to benefit somebody that invests in the right areas of healthcare. Same might be true of energy and so forth. Congress is going to do what it's going to do, but we're not. If we wait now to figure out what Congress is going to do with President Trump, we could wait a year or two. I don't think legislation is going to be passed that's going to be important and significant this year. Maybe next year some will be passed, but I think long-term investments are really looking at different factors than what Congress is going to do.
Yeah, I would tend to agree that there's this kind of valuation impact around perception of things changing, which can be very distorted in over a year period of time. But I mean, healthcare is a great example. You know, we went through healthcare reform scares back in 1994. We went through the healthcare reform, which overpriced some healthcare assets 2 or 3 years ago, and then now we're seeing repeal and replace. But the truth of the matter is the fundamentals of more consumerism in healthcare, more value-based payment technology that's coming into healthcare, more privatization of the public side of healthcare going on. All of those trends, I think, persist and continue to be invested in. I think that people lose sight of those fundamentals when they're talking about one-year periods or regulatory swings that really are only going to have a short-term impact.
In healthcare, just for a moment, right when I worked in the White House in the late 70s, 8% of the GDP of the United States was in healthcare. Now it's probably between 18 and 19%. The baby boomers are aging. 10,000 baby boomers are turning 65 every day. And we now have about 13.5% of our population 65 or older. And as this population ages, they're going to need a lot of health care. And they are the wealthiest. The baby boomers are the wealthiest people in our society, and they will spare no expense on their artificial hips or artificial knees, their transplants, whatever it takes. And so no matter what Congress does, in the end, there's going to be so much money going into that area that I think if you invest in it reasonably intelligent, you're going to make a fair amount of money because this is a major part of our economy.
Yeah, no, I agree. It is interesting because we spent almost a decade, 8 years, focused really on monetary policy. Are rates going to go up? What's the Fed going to do with their giant QE unprecedented experiment? And now we have fiscal policy to worry about. And so we're a little rusty at assimilating or trying to figure out what they're doing and where they're going, and maybe for good reason, by the way. And yet it doesn't stop us. I think as investors, we want to make sure we're investing, probably all of us, in ways that are not really dependent on moves that are really unpredictable by this administration. In fact, many. In fact, and those administrations that are pro-business or not characterized at the outset often are not well correlated to how well we do anyway. And that may be the beauty of this asset class, because we're, in the end, when we invest, we're probably changing the shape of a company, doing something that isn't tied to GDP or public policy if we've done it right. And so the rhetoric and the focus is probably on fiscal policy and sudden changes is probably overweighted in terms of what really matters in prosecuting our respective businesses. Right. That's the sense I get from colleagues and across the industry.
Bruce, would that be equally true for you on the infrastructure side if we did see actually a massive investment fiscally driven in the United States?
Look, I think in infrastructure as a private equity investment class or just as an asset class on its own, I would say that it's been a tough ride over the past 20 years to continue to get assets off of governments' corporations' balance sheets. 15 years ago, we cracked corporations, and we started buying power plants from paper companies, et cetera. And so it's happened, and those assets have come off of corporations. The next step is really the fact that governments can only finance their balance sheets by passing those costs on to the consumers. And look, I think what the Trump administration is doing, if they find if they get a team of people that can help the cities and states work and put infrastructure into the market, it will be great for America. And the good news is it doesn't have to be reinvented again. This has been done in Australia in a very significant way. It's been done in the UK in a very significant way. It's been done in Brazil. It's been done in Colombia. So the model's all there. And I think it'll be great for the country when that's done, and I think it'll be positive to GDP. So they're on the right track. It's all about execution from here on.
I think that is one of the great growth areas in infrastructure investing. And think about it. In the old days, we used to call this pork barrel legislation. If you wanted a bridge or an airport built in your district, it was called pork barrel. Now we call it infrastructure. And who doesn't like infrastructure? Everybody loves infrastructure. And the truth is, Congress and the Democrats and Republicans do agree on one thing. We need more infrastructure. Everybody agrees on that. The question is how to finance it. It will get done. And I think if anything passes the Congress this year of significance the president really wants, it's something related to infrastructure, because the country clearly wants it. How we finance it, how we pay for it, will be worked out. But I think that will be one of the great investments. The real issue is, what's the rate of return for people like us? Is it really a single-digit rate of return, or can it be a double-digit rate of return? And that's, different types of infrastructure. But I think it will be one of the great areas to invest in over the next 5, 10, 15 years in the United States. And I think in the emerging markets, while it's riskier building infrastructure there, that can be a very attractive area as well. But it's not quite as reduced in risk as I think it will be in the developed markets, particularly the United States. I would also like to make a point about the diversity of private equity. We have here somebody from Washington. We have Providence, we have New York, we have Boston. I mean, what more diversity could you want? We have the whole East Coast. We have gray suits, we have striped suits, we have plaid suits, we have loafers, we have tied shoes. I mean, look at the diversity of this industry. You can't beat this diversity. Right?
Well, I'm glad I could make my personal contribution to that. I'm from California.
Okay. See, we have California too.
That's very diverse.
Yeah.
What? David, are you on the diversity committee at Carlyle?
I am the diversity committee on Carlyle. No, we have actually a diversity committee, and we actually it's actually an important area about private equity. I think private equity probably was, like hedge funds, a male-dominated business. We've made changes in it, and we have a lot of very prominent people in our business who are firm who are women and who are minorities, and I think the industry is moving in that direction. I think we could probably do a better job than we've done to date, but I think it's an important area for change in the industry. I think private equity has probably done a better job than the hedge fund industry, but we still haven't done as good a job as I think we should. But I'm just pointing out that diversity is an important part of what private equity people are doing to try to say, look, we're not the evil people that people once thought we were. We're diverse, we are actually creating jobs, we're saving jobs, we're paying taxes, and we're very concerned about environmental and social and governance issues, where I don't think we were 20 years ago, or maybe even 10 years ago. But the industry has been really affected dramatically by the concern by investors and others that we should make these changes, and I think people in the industry were making these changes, and I think that's one of the most important things that's changed private equity in the last 5 or 10 years. We are not seen as people who are trying to destroy some of the things that people think are important to our country and to other parts of the world. So I think, while we shouldn't pat ourselves on the back, the industry's made real progress in this area.
David, when you say that, and maybe I throw this to the rest of the group, would you say the industry has made progress in what the industry is delivering, or it's done a good job of changing the narrative?
It's done 3 things. It has made progress in addressing the fact that we have to deal with it. Before, I don't think people cared about it. I think in the early days, when Mitt Romney ran for governor and for the Senate, and he ran for president, he was heavily criticized for some things that were the kind of things that maybe people did many, many years ago. But in the industry, it's evolved a lot. So I think we've made progress in addressing the need to do something. I think we've actually made real progress in diversity, in ESG issues, but I think there's a lot to do. So I wouldn't say it's all public relations. I think we do publicize more than what we do, but I think there has been some real progress compared to where we were even 10 years ago.
Yeah, I mean, I think, with my former colleague, Mitt Romney, being politicized around those issues, I think it created a difficult wake-up moment for our industry. Frankly, it has been a growth industry, and it has been an industry that's created jobs. It has been an industry that's globalized firms. It actually has been an industry that's also had to create operational efficiencies. None of those things, at least as I understand capitalism, are bad things, but I do think our industry has also understood that we need to have a real understanding of the values-based elements of our society today, which certainly all the millennials in my firm are very focused on the values of our organizations. The values of employees associated with companies that we own are really focused on governance and focused on the environment and focused on sustainability. So it's not just a transparency of what we were already doing, but it's also the sensibility of, I think, our world today. And I think it creates a huge opportunity for people who are trying to retain talent, attract talent, and for companies to be leading with their consumers and their customers in a way that I think is actually quite healthy.
I think we have...
Yeah,
Go ahead. Sorry.
I agree that we've made a lot of progress, but we were starting from a really negative position. So I'm not too relaxed about our standing in this country and around the world. It's much better, but I think that partly we've done well because we've been displaced by other bigger issues, bigger villains or threats. That's number one. And two, while we have a campaign to explain what we do, actually what we do is complicated and comes in many shapes and sizes. I mean, some are growth-oriented, some are invest in different industries that may be closer to the consolidation and contraction and rationalization phase, which is a messy picture, even when you do it the right way. When Josh Lerner's work is I think about the best work done on really the numbers around this industry, that's not an easy story to tell, because for the first 2 years it looks like, compared to average set of public companies, employment shrinks, but if you look at a 5-year period, it grows. So that sounds long-term like a positive thing, but that first initial period, across the board, not saying this group, but as an industry, at least in buyouts, that sounds complicated. So I'm not at all relaxed about it, because after all, and even this audience these are largely suits, and we just learned that we're kind of out of step with the US, certainly, and we're seeing the same thing play out in Europe. But one point, though, that is really important, that all public pension funds understand, even though they're quiet about our role in it, is that this asset class, broadly defined, is critical for meeting the obligations of workers, public, private, in the US and indeed around the world. Most funds are underfunded in the US, even with aggressive actuarial assumptions and return assumptions, they're underfunded. The one class that over and over again outperforms, in fact, in this near zero interest rate world, and very high, so that rules out fixed income for the most part of meeting obligations, and public equities trading at near or at all-time highs, this asset class stands out as the one that can actually has a shot at making the books balance. And that's a critical role for all citizens, because it's not really, well, the industry tends to be personified by people like us. The beneficiaries are very broad-based.
So I would just add to that, and I think the narrative, what's really important actually, and when you say the big numbers that we all manage and run in all these businesses and private equity, but what we actually do, we have amazing businesses. We deliver water to 17 million people and take their sewage away around the world. That's amazing. These people would, in many countries that this is in, they would die if they didn't have clean, fresh water and got their sewage taken away. So these are what we have to do, I think, in the industry, and we have to do better, is to tell the narrative of what we actually do at the basic level. And the story, and part of it is our model is to hold things a lot longer, and our permanent capital entities allow us to do that in some cases. And it's the flipping of assets which often catches the headlines, and that's what some of the negativity is about. But when you look at the actual businesses, some of them are incredible businesses, and that is, I think, the narrative that we have to tell in the industry.
Great. Now, Jonathan makes a very good point. Why does private equity exist? It's obviously not because of the charm and good looks of the founders of these firms. It exists because the rates of return have historically been somewhere between 600 and 800 basis points over public market indexes around the world. And as that 600 to 800 basis points is a big difference if you're managing billions of dollars and you're a pension fund. If you can get that 600 to 800 basis points on an average, and if you get a top quartile fund, you're going to do much better. That's why we exist, because these rates of return are necessary for the underfunded pension funds around the world. And I think the paradox of private equity right now, today, is one thing. It is that rates of return are coming down, even though they're higher than any other asset classes. They're coming down a bit. Net internal rates of return 15 years ago were probably in the 20s. Now they're probably in 15, 14% net internal rates of return. Returns are coming down. Prices are very high. There's a lot of dry powder. Why are people giving record amounts of money to people like us? It's because the rates of return are still much higher than anything else, and people are willing to accept lower rates of return. The principal change in the last 10 years in the industry is that I think investors have recognized that even if you cannot get 20% net internal rates of return, getting 15% on average is still pretty attractive compared to everything else. And I think as long as we can continue to get rates of return in that range and above by 600, 800 basis points, average public market indexes, the industry will continue to flourish and grow.
John, please.
Well, and I also think that the world continues to get more and more competitive, and I think the nature of all of our institutions is that we don't stand still. I think the fact that 15 years ago we weren't global, many of us, and became global. The fact that we're trying to figure out how to act more like strategic acquirers by having even deeper vertical expertise in the industries that we participate in. The fact that we all have different stories to tell on how we add value to companies, but the industry has changed a lot in the last 20 years, 28 years since I've been doing it, where every year our ability to act more like strategic acquirers, act more value added in what we're doing, it may be at lower returns, but still pretty good returns based on our business models, are about doing that with companies to transform them. And I think that story also continues to be not told as well, I think, because I think that's also been really established at some of the larger firms where we really can do remarkable things with companies.
Yeah, I don't know that we've convinced everybody that private equity is the highest calling of mankind, but I think people still think that it's a pretty noble thing to do, and we have to do a better job of convincing people. As you say, we operate companies that do terrific things for people. We're getting good rates of return for people, and in the end, we're really adding value to society. We have not done as good a job in explaining that as we should have.
Let's use maybe John's point to transition to a bit of a conversation about where you see the market writ large, recognizing there's multiple sub-markets here, but where you see it going as we look in 2017 and beyond. One of the less discussed facts of the industry is it is a cyclical industry. Returns do go up and down in some form of a cycle. Fundraising goes up and down in some form of a cycle, et cetera. Do you see us, where do you see us, if you believe that point of view, in that cycle now, if anywhere? And are there any secular things you see coming over the course of the next year or two that you're taking into account as you think about your investing?
Secular and looking at a 1 or 2 year time frame is, those are sort of...
Sorry, you're absolutely right.
Those are in conflict with each other.
Point taken.
It is kind of funny because I know I was a Bain guy, you were a McKinsey guy, and of course we can pick on the BCG guys when they predicted the demise of the private equity industry back in 2009. And frankly, it's been picked on a lot of times at this point in the cycle. Back in 91, at the end of sort of an era associated with this conference, I suppose, I was told that you don't want to get into this industry. It's an industry that's going away. And then, of course, during the internet and telecom bubble, I think it was also predicted to go away.
Yep.
We are going to go through a cycle. And I think this one probably, more than any other one, likely will be a valuation cycle versus an economic cycle. But we're far more diversified, and we're doing things in a secular way that are very, very different than we were doing in the prior cycles. And so our ability to be diversified, to not look at 1 or 2 years, but say, what are we going to be doing in the next 5 years to really compete effectively in each of our strategies? I suspect you're going to hear a different story, but it's all going to be about how we actually can contribute value to the investments that we actually make. Mm-hmm. And we do it in different ways, and our industry has grown up a lot, but that's a big growth opportunity. I see it all the time with corporate carve-outs. I know we do a lot of those. These gentlemen do as well. We see it with growth businesses, with founders still. Believe it or not, we're still backing founders in 2016. And we also see it with cross-border, where companies in the U.S. Are looking to expand in Asia or Brazil. And we're trying to build businesses based on our domain expertise, our ability to sort of transform those companies and grow them in those markets. So I think the industry is incredibly healthy right now. And I do think governments are now realizing we are part of the solution. Right. I think boardrooms have always thought of us as a really important leverage point to engage with, to solve their problems, whether it be divestitures or spin-outs or even partnerships. And so I think the industry is at an extremely healthy point right now, but it will go through, I think, a cycle again.
I think that the principal changes I see over the next 5 years or so are the industry will become more global, more money will get invested outside of the developed markets. Sovereign wealth funds will become a bigger part of the industry. They're now about 17% of the capital that we have. They'll probably go up into the 20s, getting close to what public pension funds are. You're going to see more retail investors than ever before. Retail investors in the sense of people who are high net worth people who are coming in through feeder funds, but you're going to see the 401k and IRA market ultimately open up for private equity, and that will be a gigantic source of capital. I think you're also going to see more people interested in longer-term holds. Some investors say, don't give me the money back every 3 or 4 years, hold on to it for a longer period of time. I think you'll see more of that. I think you'll also see more private equity firms getting started. There are 6,000 in the world now, and that's gigantic compared to just a few years ago. But in many emerging markets, you're going to see many more private equity firms getting started. I do think that the Americans will still dominate this business. Interestingly, while we're only 18% of the world's GDP and 5% of the world's population, we're 100% more or less of the large private equity firms, leaving your firm aside, let's say, in Canada.
The Americas.
I'm sorry?
It's the Americas.
Right. So the Americas dominates this, and it's a great thing to dominate this part of the financial service world. I think that will continue for a long time because it's very difficult to build these organizations up and raise the amount of money. I don't think anybody in the emerging markets can quickly raise $200 billion to do this. So I think the United States and Canada and the Americas will kind of dominate this business for at least the next 10 years. And I think while rates of return could drift down a little bit, still I think the rates of return will still be so attractive that you're going to see more and more money flowing into this industry. Right now, it's probably the easiest time ever to raise money. That may change, but right now, it's very attractive to a lot of investors.
I've been at this long enough to have remembered all the predictions that were wrong about where we're headed. And it's not that I disagree, but I'm also comforted by our history, which is that it's been an incredibly adaptable industry. And that's by construction, that we are more nimble historically than many other asset managers as a group and financial players. So far, we're not hamstrung the way banks have been to their detriment regulated. As long as we continue to be responsible, it's very interesting how if it turns out that long hold, low returning assets are in favor, we will quickly meet that demand.
Sure.
I mean, rest assured, many already are. If the banks are out of the lending business as they have been, we fill that role. It's created an incredible opportunity for us. And in fact, it's amazing the amount of assets, origination, processing, that has happened privately, mostly in the US, to fill the shoes of banks. I don't think anyone could have predicted that 15 years ago. That's one I didn't hear. So I think that we will change in shape, we will keep growing, we keep getting better at this, and providing actually a fundamental need in capital markets and society generally. So pretty relaxed about it, and most practitioners are not, and I suspect this is true for all of us, are not too hung up on cycles because it's really impossible to time. We actually counsel our investors not to get too caught up in vintage years and good timing, because there's a lot that happens between commitment and actually investing it and getting it back. So even if you knew, I'm not sure how you'd play that. Best answer is commitment to the space. And I'm not saying that in a self-serving way, but it's impossible time. I would say about public equity, and we are not engaged in that business. Market timing is tough.
So I'd add three things finally to this question. Number one, I think scale is going to become more important every single day. Just the size of deals and the ability to do larger deals and to be able to bring in co-investors, our clients with us, and to do bigger things just makes the differentiation more focused on the ones that have scale. Number two, I think global. The businesses are global. Yeah, they're not that global. They're going to become much more global, every single one of them, because people want to have one place to go to do investing in one certain area. And they want it global, and they want to have that relationship. And third, I think what's increasingly going to be important, and everyone here has this in some form, we all have it, but increasingly the operating platforms to be able to take the businesses you buy and to turn them into something else is going to be the difference between X return and X plus 600, to your point, David. That really is going to be the critical difference. So the ones that will take the business and not just be a financial arbiter, but to actually operationally rework them and remake them is going to continue to be more important every day.
Well, that's the principal change in the industry over the last 30 years. 30 years ago, the industry depended a lot on leverage, and it depended a lot on macroeconomic factors. When the RJR deal was done in 1989, it was 5% equity and 95% debt. In those days, 5% equity was relatively standard. And therefore, the deals were very highly levered and depended on macroeconomic factors being very good. Today, with equity roughly around 40% or so, it's not quite as levered, but also every one of these firms here has a lot of operating partners who actually know how to operate companies. We're not just investment bankers who know how to leverage something up. And as a result of that, I think the value added from these private equity firms is as good as the private equity, the value added that can be operated, that can be given by large industrial companies. And so we hire many of the people who are the best managers in industrial companies and now work for people like us, adding value to these companies. So the industry's changed dramatically. The issue that I often worry about is who's going to disrupt us? Everybody's always worried about being disrupted. At some point, somebody will come along with a better business model than the business model we currently have. I don't know exactly what it will be, but at some point there'll be some changes in the next 5 or 10 years where somebody will come along, some 3 guys in a garage or 3 girls in a garage in Palo Alto and say they've got a better way of doing what we do. But for the time being, I think the industry's in pretty good shape and is probably more acceptable to investors and the general public than it was 5 years ago, 10 years ago, certainly 15 years ago.
Well, if you think about, you touched on this a moment ago, David, mentioned that change in your funding sources over time, retail, but perhaps even more importantly, the sovereign wealth funds. If I think about the sovereign wealth funds, and you mentioned it going up to 20%, increasingly that number seems to, as a percentage of what it was before, to be invested directly in some form. Arguably, the Canadian pension funds in particular have been getting more comfortable with direct investments. And many of the U.S. public pension funds have been comfortable with real estate direct investments. And so if arguably the disruptor could actually be your funding source.
Well, I think there should be 11th commandment that says you should not invest directly. You should invest through a private equity firm, but probably that's not going to happen. I do think that many people are interested in the so-called Canadian model. and CalPERS recently said that they might consider this as well. You have to remember that Canadians are compensating their professionals at pretty high rates of return, or pretty high salaries compared to what American public pension funds are likely to do. I think it's going to be difficult to hold on to the talent, because if the talent really gets skilled at this, they probably will go to a private equity firm. But I don't think that's the biggest disruptive factor, but it is a potential disruptive factor. I think other disruptive factors would be compensation, fees, and other related things that could come along and change the industry. But right now, while I don't want to be complacent, I think for the next 5 years or so, the industry's in a pretty good shape. I don't think we have political problems. I don't think we have governmental problems of any consequence. The biggest problem I foresee is some macroeconomic event that we can't control or anticipate causing some kind of economic slowdown, and that would be the biggest problem I worry about.
Yeah, it's interesting that the rise of the shadow market in our space, whether it's sovereign wealth funds, SMAs, which are not specific to sovereign wealth funds, which is 20% roughly and rising. So it's the fastest growing category. So let's say it becomes a third soon. I wouldn't view that as a threat as much as move in economic balance. It's a way to reduce fees and gain control for investors. I don't view it as direct competition. First of all, I think what each of us do depends on a team of practitioners. It takes a long time to assemble. It is not easy. It's actually independent of how much capital you manage. It takes 15 years or longer to assemble a group, to get them to work together and figure out who's actually superior at this. So I think that takes time. That's a constraint on sovereign wealth funds. And Mike, most of with the exception of a few Canadians, and who knows where CalPERS goes, their goal is not to compete with us, but to get as much deal flow as they can, which actually, that model argues not to be independent like us, but to invest in funds and demand or get over market share of co-invest opportunities is actually their goal, I think. It wasn't long ago that a threat to private equity was going to be hedge funds. It seems laughable now because they're shrinking, but at the time they were growing and they were much bigger than private equity. And the argument went, if they just allocate 15, and they all had side pockets, if they just allocate 15% of their assets, they will swamp the boat and that'll be the end of us. And it never happened.
Well, and the other one, frankly, that was out there back in the peak of the last crisis were major financial institutions. The banks all started to develop, and you figure they would have an enormous amount of talent to be able to deploy it, but even they themselves suffered greatly by not being able to attract the best talent, having an assembled team, having a long history of investment practice, and that was a huge cycle that caused all of them to, with regulation as well, but certainly they all shrunk those platforms or got out of that business.
Right. Well, there's another one that's now arising, which I won't say will disrupt completely, but it's the so-called family office. In the old days, very few people had family offices. David Rockefeller might have had one, or Hillman had one, or Whitney's had one, but now everybody I run into has a family office. And it seems as if people, in the old days, they wanted their child to grow up to be president of the United States. Now they want their child to grow up to have a family office because that's the measure of success. So family offices now have gigantic amounts of money because some entrepreneurs have made $10 billion, $20 billion, $30 billion of net worth, and they're investing it through a family office. And a lot of these family offices are prepared to hold on to assets for a long time. So they are, in my view, probably more competitive and a bigger competitive threat than sovereign wealth funds, which I don't think will probably have the staying power to do what family offices will do.
I think the only thing I'd say, David, is I actually think some of these sovereign wealth funds, and particularly the Canadian pension plans, and there's probably 5 or 7 or 10 others in the world, they are going to build great organizations, and they're going to do direct, and they will be competitors to us, and they are competitors to us today. I think the important thing is, and not as much in private equity, but we see it in real estate and we see it in infrastructure and somewhat in private equity. The important thing is interest rates in Japan are 0 out to 30. Interest rates are 25 basis points out to 30 in Germany. They're 9.99 in the UK, and there's massive amounts of money that has to go into all these products. And there's new funds and new pools of capitals being created every day. So I think there's enough for everybody. We can all grow. Like, we don't need every dollar in the world. We have little businesses relative to the global capital flows, and we can all be very successful with the clients we have. And those people can all build their businesses with us, as you said, as co-investors and on their own. But it's the, because you said it takes 15 years. It took us 30 years to build what we have, and we're not even there yet. But the money keeps coming in, and I think that's the important point. It's just that
we haven't even mentioned the greatest value of them all is the publicly traded private equity firms. Their stock prices are so low that there's a great bargain, and people might consider that because they're undervalued, and that's
Should we take you private, David?
We'll look at
we
your
could take you
stock
private
afterward.
if you like.
Well, you have your first activist investor right now investing in one of them. Actually, let's use that to talk about something that this panel wasn't inadvertently picked. Everybody here has a slightly different operating model, maybe even a very different operating model in terms of the amount of permanent capital, if any, you have, the range of different funds or different investment areas, degree of globalization. I'd be interested in just how you came to, was there a core operating principle that got you to the model that you have, or was it a function of the talent that you had and what people wanted to do, or some combination, or something else? But how did you evolve to the model? You talked about adaptability. How did you get to where you are now?
I think that as one that has always been asked for the last, I guess, 10 years, 12 years now, why haven't you guys gone public? I think there are different models, and I think they can do quite well and coexist. I think it is a little bit about how you were formed to begin with, and the private partnership that we developed. We always just wanted more of the upside. And so from our perspective, every time we were faced with the prospect of could we get more of the carry, more of the co-investment, that was our orientation. Even back in 2007, when people were talking about going public, we actually said, well, we'd rather capitalize our business by actually raising debt with low cost of capital to then deploy the capital so that we'd have more of the upside. So from our standpoint, the value of our model is not just to be big, but just to have more of the upside. And so our orientation has always been to be huge co-investors, I think, to actually make sure that the next generation can actually retain the equity. And I think we don't have an equity model, which is a useful tool for talent, but we do have the prospect that people can get more of the upside by handing it down generation to generation.
I'd say that if you go back and look at the original business plan for Amazon, for Microsoft, for Facebook, and for, let's say, Apple, none of them bear relationship to what the companies ultimately became, because things evolve. And I think all of us probably had much different visions of what we were going to build than we ultimately built. And so it took many years before we kind of evolved in these models, and I don't think it's a grand strategic plan that we had in day one. In our case, we decided that was novel at the time to have a second fund. Historically, private equity firms only had one fund. We decided to have a second fund. That was different. And then we decided to build out a series of funds and then do it globally. And so our business model has been to have a variety of products available to our investor base, and hopefully our investors will think they're comfortable with us in one area and they might invest in another area, and then take advantage of all the investment professionals and have them work together and theoretically add more value. And we've gone public for a number of different reasons I won't go into now, but we think it's probably a good thing for our business model. But we've evolved it over a period of time, and I can't tell you it's perfect, but it works for us.
No, we certainly, I had no idea 26 years after starting Providence we'd be where we are today. So I agree with David completely about that. For us, we did raise permanent capital, and the thinking behind that was we had, when we started a credit business, we were really funding it with our balance sheets, and it seemed to us not to be the right way to build out a business constrained not by human resources or by an unmet demand in the market, but what we could afford personally. So we raised capital. It did allow us to build a credit group called Benefit Street Partners that we couldn't have done without the permanent capital we raised. So in that sense, it enabled us to get into a separate profitable business. We're glad we're in it. And none of the capital escaped the system. None of it went to partners. There's no obligation to be public because for us, that was a choice. We would rather be private than public, recognizing that others were more comfortable and aided by public liquidity. That was just not our goal. So we were kind of in between where John is and David today, and we're comfortable with it because it gave us the horsepower to build a business and actually accelerate our even our equity business. We're a focused fund, but away from the flagship, we did start a small growth fund that those initial set of investments we did on our balance sheet, bolstered by the outside investors, which then became a fund, and our investors and the general partner is happy we did it. So it worked out well.
So Gary, I'd end by saying you're right. The models are very different. So we've been public for 50 years. When we merged a bunch of public companies together, we have a 50 billion market cap, and we have a further 50 billion of listed perpetual capital vehicles that support our all activities. So this is a much different model. So we raise private funds, and they're partners. Those listed entities are perpetual partners of our private funds. And so I'd say we've always been public. So when everyone was talking about private equity firms going public, I was kind of grimaced because we've been public forever. When people talk about raising perpetual vehicles, I always think, geez, that's funny. We have 4 of them that trade in New York, and they have 50 billion of capital. We've always been a little different, and I just think that there's no one model that fits any business. It's going to be each model that fits the specific strategy, and they do evolve, as you said, David. And I think they evolve for the better. And there is no one right model. I'm positive of that. And there never will be.
Bruce, if I understand correctly, you also have different public listings for different parts of your business, too. Is that accurate?
Yeah, so we have the 4 segments we operate in are real estate, infrastructure, renewable power, and private equity. And those 4 businesses each have a New York Stock Exchange listed entity called Brookfield, one of those names. And they're in size between 5 and 25 billion of equity market cap, 25, 15, 10, and 5. And those trade in their listed perpetual vehicles, and they pay a distribution, and they invest beside our private funds. In fact, some of them have our institutional clients invested in them. So some of our institutional clients have invested in those entities they're in our private funds, but they're also in the listed entities with us.
I could make the argument that each of you have evolved your firms into a degree of complexity, I think positive complexity, but a degree of complexity that, to your point, you would never have envisioned when you first founded the firms. If I think about that in the context of talent management, how has the way you've thought about talent running across the different parts of your organizations changed relative to what you might have envisioned initially?
Well, I mean, the natural thing about investing businesses, you got to have really, really talented investors. And it seems like an obvious statement, but I think the way our business has evolved you're not building a factory. You're not building even a professional service firm with leverage, which we know well in a consulting context. You really have to have fundamentally really good judgment, engaged people in the investment process, frankly, even in the value addition process. And I think doing that means you have to be pretty flat organizations, at least in my mind. And once you have those kinds of organizations, it's a great career. It's a great way to make impact. And it's a great way to create wealth as well. And certainly the longevity of our people, I think our average partner is 15 years. And they've been at the firm for a very long time because it is flat, or it is empowering to them to actually be able to make an impact in companies, and they're good investors. And so I think a lot of us got big pretty quickly, and I think we realized getting big doesn't necessarily mean you're better. You don't want to have leverage in your system. you want to make sure you have really, really good investors.
You have to keep hiring talented people who you think are smarter than you are. If you hire people you think are not as smart as you are, in the end, that business is going this way. So you got to keep hiring people who are smarter than you, who are aggressive, and who still have an entrepreneurial instinct. As the organization grows, it can snuff out entrepreneurial instincts. You have to be careful to make sure you're getting people who really have some entrepreneurial instinct and are not interested in making money only for the sake of making money. They want to do other things. They want to build something. They want to prove that their capabilities, and they want to do something useful with their money as well.
Maybe we are quite literally at the 2-second mark. So I will close on that comment. If we had more time, I actually would have spent some time talking about some of the philanthropic interests of our panelists, which have been quite incredible if you looked at what you all have collectively done with your money and your time.
Just curious, how many people here want to invest in private equity more than before you came here?
There we go.
You know,
Okay.
How many people left?
Thank you all for your time.